Hello, and welcome to Portfolio Matters Beginner's Guide to Bonds. What's the aim of this podcast? I'm aware that a lot of our regular viewers of the weekly skip the rates section because they don't really understand about bonds. Now, at the end of this podcast, I hope that will change. I think the rate section is currently the most important section of the weekly, because central banks of the world are raising interest, and that affects the price of all asset classes. Now, by the end of this podcast, I hope you will understand how bond prices change with interest rates, understand some basic bond terminology, no longer want to skip the rate section, and feel confident enough to invest directly in sovereign bonds and bond ETFs. So, what is a bond? Well, a bond is simply a loan that can be bought and sold in the market. In this podcast, we will be concentrating on plain vanilla bonds, by which I mean there is a terminal or redemption date for the bond at which the principal or par value is repaid. And during the life of the bond, it pays interest at regular intervals. So, essential points. The most important thing you need to know about bonds is that as interest rates rise, so the bond price goes down, and vice versa. As interest rates go down, bond prices go up. So, the best time to invest in bonds is when interest rates are falling. And the coupon on bonds is fixed. So if you think of coupon payments as the dividend payments from the bond, they do not vary over time, and they don't rise with inflation, unlike, say, equities. An equity is a share in the profit of a company, and as inflation rises, so companies can change their prices with inflation. And so you'd hope that dividends paid on equities rise with inflation. In the case of a bond, the interest payments are fixed in the legal documents that outline the contract for the bond, and they do not vary over time. So as inflation rises, the real value of the interest payments falls. Now, there are exceptions. Index-linked gilts and Treasury inflation-protected securities, TIPS, are inflation-linked, and we will briefly cover those, but that is not the main aim of this podcast. So, reminder, bottom line, bonds perform well when interest rates are falling, which generally means when inflation is falling, and they perform badly when inflation and interest rates are rising. So currently we are in an environment where inflation is still rising and interest rates are still rising, and that has been bad for bonds. Another way in which bonds differ from equities is that a bond has a terminal date at which the principal is repaid, and so it has a known terminal value. UK government bonds, for example, have a face value of £100. So at the redemption date, they will pay back £100. If you are a long-term investor and you invest in bonds and hold them to maturity, you will get exactly the return that you calculated when you bought them. Now, in the market price of those bonds will change every day, but that need not concern you. The only thing that could affect that is if the issuer defaults. But in the case of sovereigns such as the UK or the US, that is very unlikely to happen. In the case of sovereigns such as Argentina, that's much more likely, and we will discuss that. Okay, so what are the risks attached to bonds? Well, number one is interest rates. If interest rates rise, so the value of the bond falls. And interest rates are highly tied to inflation. Since the early 1980s, central banks have had an inflation fighting mandate with a price stability target. So as inflation rises above 2%, so central banks have to increase interest rates to reduce inflation back towards the 2% target. The other thing you need to be aware of is that longer maturity bonds are much more price sensitive to changes in interest rates. And a bond's price sensitivity to interest rates is given by its duration. Now, we will discuss duration without going into the actual formula for calculating duration, but I will do a separate podcast showing you how to calculate duration. Now, it's not necessary to know how to calculate duration. All you need to know are longer duration bonds are more price sensitive to interest rates. Many investing websites will give you the duration of different bonds. And finally, credit risk. Now, and finally onto credit. Now, credit risk is the risk that the issuer will no longer be able to meet the obligations of the bond, either to pay interest or repay the principal. And the bonds of big developed world governments should have no credit risk. So the US bonds are said to represent the risk-free rate. They're assumed to have no credit risk. However, the bonds of smaller, particularly emerging market countries, do have credit risk, particularly if the bonds are issued in foreign currencies, such as the US dollar. To give you an example, earlier this year, Sri Lanka defaulted on its US dollar government bonds after it got into balance of payments difficulties. Corporations also have credit risk, and we will go into that. Now, this is an example of a bond. This is a UK government security with the 2050 gilt, and it has a par value of £100, and it will be redeemed on the 22nd of October 2050. So if you hold the bond to that date, then on that date you'll get back £100. In the meantime, it pays interest of 0.625%. So the coupon is said to be 0.625%. And the details of all the gilts in issue can be found from the Debt Management Office website. And these are the details of the 2050 gilt. See, it has a unique identifier called the ISIN code. And the redemption date is the 22nd of October 2050. It was issued on the 10th of June 2020, and it pays dividends twice yearly or semi-annually on the 22nd of April and the 22nd of October. And currently, there are almost 32 billion in issue. So this should be a big liquid security. So some key terms you need to know about bonds. Well, par or principal is the nominal value of the bond, the amount that the bond issuer agrees to repay the holder on the redemption date. And for the 2050 gilt, that is £100. The coupon is the interest payments that the bond will pay as described in the issue document. Now, for the 2050 gilt, it pays interest of 0.625%. So the coupon is 31.25p paid twice a year, or 62.5p per annum on the principal of £100. So each bond is worth £100 and pays annual interest or annual coupon of 62.5p. The coupon payment dates are the dates on which the coupon is paid. For this particular bond, it is the 22nd of April and the 22nd of October each year during the life of the bond. Now, there are several different ways to describe the yield on the bond, and it's very important that you understand the different terms. So the coupon yield is the annual coupon payments divided by the par value of the bond and does not change over time. So in the case of the 2050 gilt, it is 62.5p divided by £100 equals 0.625%. The coupon yield is fixed. It doesn't change. The running or current yield is the cash flow yield of the bond, i.e. the annual coupon payments, divided by the current market price. And the current market price can be very different from the par value. So for the 2050 gilt, when I was putting this together, the market price was £40.16p. And so the running yield is 62.5p divided by £40.16 equals 1.56%. And the yield to maturity is the yield given by all the cash flows expected from the bond, including its redemption payment, divided by the current market price. It's essentially the internal rate of return of the bond, and that requires some calculation. Now, many investment websites, including Bloomberg, will give you the redemption yield of the bond. For UK gilts, the Debt Management Office have outsourced those calculations to TradeWeb, and TradeWeb is free. All you have to do is register, and they will give you the redemption yield for all UK gilts as of the close of the previous day's trading, and some more bond terminology. So a bond is any fixed term security. A treasury is a US government bond. A gilt is a UK government bond. And they're called gilts because back in the old days, UK government bonds used to come in paper certificates which had a gilt edge. JGBs are Japanese government bonds. Bunds are German government bonds. BTPs, Italian. ILGs are UK index-linked government bonds, where both the interest payments and the value of the principal are linked to inflation as measured by either CPI or RPI, depending on the particular details of each bond. And TIPS are US Treasury inflation-backed securities. But having gone through all that terminology, please be aware that non-specialists, including myself, tend to be quite loose in their language when discussing bonds. In particular, they will tend to conflate duration and maturity and the current yield and the yield to maturity. So whenever you're talking about bonds, try and be specific. Always clarify what people mean when they talk about those terms. So why invest in bonds? Well, bonds have the advantage of certainty. You get regular defined interest payments, and if you hold the bond to its maturity, you receive back the par or principal value of the bond. In the UK, gilts are exempt from capital gains tax. Now, the interest is not exempt from income tax, but any money you make on the market value of the bond is exempt from CGT. So in the case of the 2050 gilt, its market price is £40. In 2050, it will return £100. And so if you hold it to maturity, you'll make £60 of capital gains, and that is not taxable. And that is a big advantage of UK gilts. Now, it's important to know that if you hold UK government bonds via an ETF, the ETF is subject to capital gains tax. So if you're going to hold UK government bonds and you're a UK taxpayer, there are big advantages to holding them directly and outside a wrapper such as an ETF. Government bonds are also very highly liquid, so you should be able to buy and sell them with a low bid-offer spread and in size. They're also less volatile than equities, although this year has been an exception. And in general, they are thought to be lower risk. But again, this year has been an exception. Now, what are the disadvantages of bonds? Well, the interest payments are fixed. And if inflation picks up, then those interest payments become less valuable. So the big danger for bonds is a rise in inflation. Corporate bonds have credit or default risk. And so if the company takes on too much debt or it does badly, then it may be unable to repay either the interest or the principal of the bond. And if the company goes into bankruptcy, then you may get very little back. And the flip side of bonds having lower long-term risk than equities is they have lower long-term returns. Okay, so the most important thing you need to know about bonds is that their price moves inversely to their yield. Now, why is that? So the simple answer is that the interest rate represents the time value of money. If interest rates are zero, then you'll pay £100 for £100 in a year's time. The time value of money is zero. As interest rates rise, so money in the future becomes less valuable. If interest rates are 5%, then £105 in 1 year's time is only worth £100 now. And so if you think of a zero coupon bond that returns £100 in 1 year's time at 0% interest rates, that bond is worth £100 now. If interest rates rise to 5%, then you can get 5% by putting that money in a deposit account. So you'll not pay £100 for a zero coupon bond. You require the bond to return 5% over the next year, and so you will pay less for it. The market price of the zero coupon bond will fall below £100. In summary, higher interest rates mean lower bond prices and vice versa. So let's put some maths behind that. Let's consider a bond with a coupon yield of 5%, which matures in 1 year's time and pays interest semi-annually. So this table summarizes the cash flow from the bond. You start off by paying £100 for the bond. Then 6 months' time, you get an interest payment of £2.50. And at the end of the year, you get £102.50. You get a return of the principal or par value plus the second coupon payment. So the cumulative income from the bond is £5. Because you paid £100 for the bond, you made nothing on the principal, on the capital value, and therefore your total return is £5. You've made 5%. Now imagine what would happen if interest rates rise to 10%. Well, you can make 10% by depositing your money with the Bank of England. And so in order to invest in this bond, it must yield 10%. Otherwise, you won't buy it. You just put your money with the Bank of England. So therefore, the market value of the bond has to fall to the point where you make sufficient money on the capital gain from the bond to redemption to give you a yield to maturity of 10%. So if we look at the payment profile again, the market value has fallen to £95.45. So that's what you pay for it in the market. You still get £5 of interest, but you also make £4.55 of capital gain. And so your total return on the bond is £9.55, and that gives you a return of 10%. So as interest rates rose from 5% to 10%, so the price of the bond fell and the yield rose to 10%. In summary, bond prices fall as interest rates rise and vice versa. To reiterate, bonds do very badly when inflation and interest rates rise, and they do well when interest rates and inflation falls. Okay, so let's discuss interest rate risks. The Bank of England base rate is the rate at which it will lend to commercial banks who deposit funds with them for 1 day. Longer term interest rates, though, are set by the market, and they're set by what investors will pay for the bonds. So central banks like the Bank of England set very short-term rates, but they have little control over longer-term rates. The only way they can affect longer-term rates is by affecting the price in the market, which means buying and selling longer-term bonds in the marketplace. And bonds of similar credit risk and similar duration or maturity should have similar yields. So if we look at two UK government bonds, the 6% December 2028 gilt and the 0.5% January 2029 gilt, these two bonds have identical credit risk, i.e. the risk that the UK government will default, and that hopefully is zero. And they have very similar maturities. So they mature within a month of each other, but they have very different coupons. So although their coupon yields are very different, their yields to maturity should be very similar. And if we look at the table at the bottom, you'll see that the 6% gilt trades above its par value. Its market price is £111. Remember that on the maturity date, it repays £100. So over the life of this bond, its market value will decay towards £100. The 0.5% gilt trades below £100. And so you will make a capital gain on that bond over its life of £18.77 roughly. As a result of which, although the coupon yields on the two bonds are very different, their yield to maturity is very similar. The 6% bond gives you a high income flow, but a capital loss. The 0.5% bond gives you low income and a bigger capital gain. Now, in that table, you will have seen that it includes the clean and the dirty price. So if you think of a bond as a loan, interest is payable every day, although it is only paid out to the investor semi-annually, twice a year. But in between those coupon payments, interest accrues. And when you buy a bond in the market, you have to pay the current holder for any interest accrued since the last coupon payment date. And if you're a seller, then the buyer has to compensate you. And that is accounted for by the clean and dirty price. So the clean price is the price of the bond excluding accrued interest. The dirty price is the price including the accrued interest, and you'll see separately the accrued interest here. In the case of the 6% bond is £2.29.5, and the difference between the clean and dirty price should equal the accrued interest. In the case of the 6% bond, it is trading above par, but as it approaches maturity date, so its value will tend to fall towards its par or redemption value of £100. And you can see that in the price of the 2025 gilt. So it matures in 3 years' time, but it was issued way back in 2018. It has a yield of 5%, and the current market yield to maturity is less than that. So it has traded over its lifetime above par. And as the redemption date approaches, its market price will tend to converge on its par value of £100. And you can see that here. Now, because UK gilts are exempt from capital gains tax, for UK higher rate taxpayers, high coupon bonds are tax inefficient because you make high income, which is taxable, and a capital loss, which you can't write off against capital gains elsewhere. Low coupon bonds are tax efficient because you get little income, but you get a big capital gain, which is exempt from capital gains tax. Now, you will have seen this in the weekly. This is the yield curve, and it shows what the yield to maturity is on UK bonds of different maturities. So the black line gives you the current yield curve, the blue line gives you the yield curve as it was 1 year ago. You can see that over that period, interest rates and inflation have risen, and so the whole yield curve has shifted up dramatically. And there's a lot of information in this curve. It shows you that the 1 year UK gilts yield just over 3%. And then as you go out towards 10 years, 15 years, so yields rises. and the yield curve peaks at around 15 years. So you get the highest yield currently by investing in UK gilt with a maturity of around 15 years. So we are talking 2037. Thereafter, the yield starts to fall. And the reason is UK pension funds have long dated liabilities, and they like to have long dated assets to match those long dated liabilities. So they're big holders of long dated UK gilts, and demand exceeds supply. Hence, they're willing to pay up at the long end and yields have fallen. So, reminder that base rates are set by the Bank of England. And this chart is from late October 2022, when the UK base rate was 2.25%, but it was expected to raise rates to 3%, which is now done, and the yield to maturity of the 1 year should be equal to the time-weighted sum of UK base rates over the next year. So what the market is saying is that in late October, they weren't expecting UK base rates to rise much further than plus 3% over the coming year. Longer term rates are set by the market, and they're affected by market expectations for UK interest rates, also international interest rates, particularly the US rate as set by the US Federal Reserve. If the US has very high interest rates, then the UK will need to raise rates to attract international capital. If UK inflation were to rise, but the Bank of England was slow in raising interest rates, then international investors would be wary of holding longer-term UK gilts and would be willing to pay less for them. Therefore, the yields at the long end would rise. The other thing that affects the price of any financial asset is supply and demand. And if the UK government decides that it's going to run a large deficit, which means that it needs to fund that deficit by issuing gilts, well, it may swamp demand. That means it has to offer a higher yield to attract the capital it needs. Also, international investors will be looking at the UK trades balance and the outlook for sterling. If they think sterling is going to fall, then they're going to need a higher yield on gilts to compensate them for that. Finally, they need to be sure that the UK is a stable investment destination. And last month, we saw that in dramatic fashion. The Truss government's mini budget undermined the UK's reputation for political stability, and international investors took fright, leading to a big sell-off in bonds and a big rise in bond yields, which had knock-on effects to mortgage rates. In general, the yield curve should be upwardly sloping. The UK is actually anomalous in this regard, in that because we have a privatized pension system, there's huge demand for longer dated gilts, and that means yields fall at the long end. Most countries have a yield curve that is steadily upward sloping, because the longer the life of the bond, the more uncertainty and risk, and therefore investors demand a yield premium for holding longer dated bonds. Now, as I mentioned earlier, this year, the whole of the UK yield curve has shifted up dramatically. Now, why is that? Well, inflation's risen, UK interest rates have risen, international interest rates have risen. We've had a deteriorating UK trade balance due to the energy crisis, because we are buying international energy, paying in sterling, and international investors will then demand a yield premium for holding sterling, which may be seen as a depreciating currency. We've had a deteriorating fiscal balance as the government has promised to compensate households for rising energy bills, and the Truss government in particular was talking about massive unfunded tax cuts, which the new Sunak government appears to be unwinding, but we're awaiting the budget as this goes to air in early November. And reminder, as interest rates rise, so bond prices fall, and longer dated bonds are very sensitive to changes in interest rates. And this is the price of one of the longest dated UK government bonds, the 22nd of October 2071 gilt. So it's got 49 years left before the redemption date. In December of 2021, i.e. less than a year ago, it was trading at £150. It bottomed after the mini budget at £41 and is now trading at £62. So if you'd bought it at the end of last year, it would be worth only around 40% of what you paid for it. So you'd have made a loss of 60%. Now, of course, that also works the other way around. If you were to buy it at £60 and we were to go back to expecting inflation to be very low over the coming years and the price of the bond returned to 150, then the price would go up by 150%. So what does the yield curve tell us? So rates at the very short end are determined by the Bank of England base rate, and short-term bond yields are anchored by the base rate. So one-year yields can be thought of as the sum of the expected Bank of England base rate over that period. Now, the further out you go, the harder it becomes to forecast Bank of England base rates, and the market price is determined by long-term expectations from interest rates, inflation, and a risk premium, as we have seen in the UK. When Liz Truss announced the mini budget, the UK's risk premium went through the roof. Okay, on to inflation. So inflation is the big risk for bonds. It erodes the real value of the principal and the coupon payments. Of course, the nominal value of the principal and the coupon payments remains unchanged, but inflation erodes their real value. Now, since the early 1980s, most central banks have a price stability mandate with a specific inflation target. In the UK, the EU, and the US, that is 2%. Therefore, as inflation rises above 2%, so central banks need to raise interest rates to get inflation back down towards 2%. As interest rates rise, so bond yields will rise and bond prices will fall. So rising inflation means higher interest rates, means higher bond yields, means lower bond prices. However, there is the danger that the central bank will not enforce their inflation mandate and allow inflation to deviate from its target rate because of miscalculation. So in the UK, we have seen that the Bank of England has been slow to raise rates until this month, where it raised rates by 0.75%. And over the course of the last year, central banks have been saying that they expected inflation to be transitory. And viewers of the weekly will know we were very highly skeptical of that, and we were right. And so they simply miscalculated. They did not expect inflation to persist. And so they're now having to raise rates quickly. And that means that inflation has leapt well above their target rate due to their own miscalculations. The other big danger is political interference. Earlier in the year, when UK's then new Prime Minister Liz Truss came into office, she was talking about reviewing the mandate of the Bank of England. And that is direct political interference, which could potentially cause the Bank of England to have to change its mandate from 2% to 3%, for example, and therefore the whole inflation fighting regime would change, with potentially severe knock-on effects on the whole of the gilts market. Thankfully, she quickly backed down. Now, all central banks have more than one mandate. The US Federal Reserve has a dual mandate. It has to ensure full employment and price stability. And often those are in conflict. So currently, inflation in the US is running very hot, and it needs to get that back under control by raising interest rates to reduce demand. And part of its specific aim is to slow the economy to produce some slack in the labor market and reduce wage price inflation. And you can see that that is in direct contradiction of its other mandate to ensure full employment. In the UK, the Bank of England has a dual mandate of enforcing price stability and 2% inflation target, but also ensuring the functioning of financial markets. And last month, we saw extraordinary ructions in the UK gilts market. The rise in gilts following the mini budget was causing solvency problems for UK pension funds, causing them to sell gilts in turn. And so we had this doom loop in the long end of the gilts market, where falling gilts prices was causing further sales of gilts. And the Bank of England was forced to intervene by essentially restarting QE, which was in direct contravention of its current policy of raising rates to target inflation. Now, thankfully, its actions restored stability quite quickly. But the bottom line is there's always some uncertainty about the ability and willingness of central banks to fully enforce their mandate, and therefore longer duration bonds should have a higher yield to compensate for that risk. And Turkey is a good example of what can happen when a central bank is subject to political interference. So back in the early 2000s, the central bank was granted independence with a price stability mandate. And for the best part of 2 decades, it fulfilled that mandate, and the yields on Turkish government bonds fell. The country had good economic growth and price stability. But the price stability mandate means that as inflation rises, the central bank needs to raise interest rates and potentially induce a recession to bring inflation back under control. Now, we're currently seeing that same dynamic playing out in the US, and the Federal Reserve is making it clear that it intends to raise interest rates until it gets some slack in the economy, i.e., it slows it down. In Turkey, President Erdogan was unwilling to allow the central bank to create a recession and unemployment to bring inflation under control. and he therefore fired the central bank governor. And the central bank lost its independence, and inflation has run out of control. As inflation has risen in Turkey, so bond yields should also rise sharply. But in order to stop that happening, President Erdogan has ordered local banks to buy government bonds, therefore for repressing the rise in bond yields. All this means if you're a Turkish investor and you bought government bonds, then you will have lost a great deal of money as inflation has risen. So this is a chart of Turkish inflation. So the Turkish central bank was granted independence in 2001, and it rapidly got inflation under control. But as inflation started to pick up again a few years ago, and the central bank wanted to raise interest rates and therefore induce a recession and cause a rise in unemployment, President Erdogan fired the central bank governor and actually enforced cuts instead. So even as Turkish inflation rate hit 80%, the central bank has continued to cut interest rates. And you would expect, as inflation in Turkey has hit 80%, Turkish bond yields would also hit high double-digit rates. But actually, over the past year, they've fallen because he's ordered local banks to buy bonds. Financial repression can suppress interest rates. What it can't do is control the exchange rate. And here you see that in the last 10 years, the Turkish lira has fallen by over 90% compared to the dollar. So political interference with the central bank is very bad. It's very bad for bondholders and for people with financial assets of any kind. Inflation destroys the wealth of the middle classes. So inflation summary. Inflation is the key risk for bond investors. If the central bank has a price stability mandate with an inflation target of 2% in the UK and the US, then long-term inflation expectations should remain well anchored, i.e., long-term bonds yields should remain around 2%. Now, we've seen over the course of the last year that actually long-term yields have risen sharply well above 2%. In the US, they're now above 4%. In the UK, they're around 3.5%. And so what that is saying is that investors are skeptical about central banks' willingness or ability to enforce their mandate over the next 20 to 50 years. Okay, briefly, index-linked gilts. So index-linked gilts are UK government bonds where both the principal and the coupon payments are adjusted for inflation, and inflation can be measured using either the CPI or RPI. You need to check the details of individual bonds. And you therefore may think that index-linked gilts are a good way to protect yourself against rising inflation. Sadly, that is not necessarily the case. The problem is most of the cash flow from index-linked gilts comes from the return of the index-linked principal of the bond at the redemption date. And so they have very long duration. We'll go into duration in due course. What that means is they're very sensitive to changes in interest rates. Their prices are therefore volatile. And as interest rates rise, the price of index-linked gilts can fall and fall sharply. And that is illustrated by the price of the 2055 1.25% index-linked gilt. It was issued a long time ago and so has a long price history. And you'll see that as interest rates fell over the decades to 2021, and the pandemic. So the price of the 2055 index-linked gilt rose sharply. Way back in 2010, it was priced at around £120, and by the end of 2021, its price had risen to £300. Now, as inflation has risen over the last year, so its price has collapsed from over £300 to under 140. So over the last year, as inflation has risen, the price of the 2055 index-linked gilt has more than halved. You need to be aware that index-linked gilts are very sensitive to changes in interest rates and inflation expectations. And long-dated index-linked gilts will fall sharply if there is a big change in inflation expectations. Okay, so what is duration? So the duration of a bond is its weighted average time until all the cash flows are paid. All you need to know is that the higher the duration of a bond, the higher its price sensitivity to changes in interest rates. Longer maturity bonds have higher duration. Low coupon bonds have higher duration than high coupon bonds. And that's because more of the cash flow comes from the return of principal at the redemption of the bond. High duration bonds are more sensitive to interest rates. That means bonds with low coupons and longer maturities are more sensitive to interest rates. Now, I'm not going to show you how to do a duration calculation in this podcast. I'm going to do a separate podcast, which I cover it. Really, you don't need to know how to do this. Most bond websites will give you the duration of a bond. For our purposes, all you need to know is the longer the duration, the more sensitive to interest rates. And this chart just illustrates that point by showing the theoretical relationship between the prices of a bond and changes in yield. So the y-axis gives you the price of the bond. The x-axis gives you its yield. And as the yield changes, so you'll see the price of a 30-year bond moves much more than the price of a 2-year bond. Long-term bonds are much more price sensitive to changes in yield. And this just gives you some numbers behind that chart. A 1% rise in yields will cause a fall of only around 1% in the price of a 2-year bond, but it'll cause a 13.7% drop in the price of 30-year bonds. Now, of course, the reciprocal is also true. If yields were to fall, the price of a 30-year bond will rise much more than the price of a 2-year bond. To illustrate that further, here we have the prices over the last year of different iShares US Treasury bond ETFs. You'll see the price of the 20-year plus ETF is down 36%, whereas the price of the 1 to 3 year ETF is down only 5%. So reminder, duration gives you the sensitivity of the price of the bond to a change in interest rates. And duration is not maturity, although the two are related. Duration is derived from a mathematical formula that calculates the sensitivity of the bonds to interest rates. Maturity is just the time until the bond is redeemed. So duration is a function of the time to maturity and to the redemption of principal, plus the timing and size of coupon payments. Reminder, the higher duration, the more sensitive the price of the bond is to changes in yield. Some websites will report the Macaulay duration and some will report the modified duration. The UK TradeWeb website, which gives you the details and yields of UK gilts, reports the modified duration. Now, I'm going to give you the definitions here. I'm not going to go through the calculations. I'll do a separate podcast in which I go through how to calculate both the Macaulay duration and the modified duration. In both cases, you don't really need to know this. All you need to know is that higher duration means higher sensitivity to changes in yield. So the Macaulay duration is the weighted average time until all the cash flows are paid. The modified duration is derived from the Macaulay duration and tells you the bond's price sensitivity to changes in interest rates. Okay, let's illustrate some of those points with some real examples. So, long maturity bonds normally have higher duration than short maturity bonds. So here we have two bonds with identical coupon yields of 4.25%, one of which matures in 2027, i.e. in 5 years' time, and one of which matures in 10 years' time in 2032. And you'll see the 2027 bond has a higher modified duration than the 2032 bond. And you'll see in both cases, the modified duration is less than the maturity. So the 2027 has a maturity of 5 years, but its duration is 4.5 years. The 2032 has a maturity of 10 years and then a modified duration of 7.8 years. All these numbers are straight from TradeWeb as of the 24th of October. Okay, low coupon bonds normally have a higher duration than high coupon bonds because more of the return comes from the return of principal at the maturity date. So if we look at two bonds with similar maturities, 2028 bond maturing in December 2028 and 2029 bond maturing just over a month later on the 31st of January 2029, but with very different coupons. So the 2028 bond has a coupon of 6%, in 2029, 0.5%. And you will see that although they mature only around a month apart in around 6 years' time, the 2028 6% bond has a substantially lower duration than the 0.5% 2029 bond. So low coupon bonds have higher duration and higher sensitivity to interest rates. And index-linked gilts have very high duration because most of their return comes through return of principal at the maturity date. So if we look at two long-dated gilts, 2025, a 4.25% conventional gilt maturing in December 2055, it has a duration of 18.5 years. The 1.25% November 2055 index-linked gilt has massively higher duration. It's got a duration of 28 years. So index-linked gilts are very sensitive to changes in interest rates. And hence, they've lost a lot of money over the last year. Okay, to summarize duration, you do not need to know how to calculate duration for our purposes. All you need to know is that the higher the duration is, the higher the price sensitivity of the bond is to changes in interest rates and yields. Longer maturity bonds have higher duration, lower coupon bonds have higher duration. You should also be aware that duration is not fixed. It will change over time as a bond approaches its redemption date. Okay, moving on to credit risk. So credit risk is the risk that the bond issuer will not be able to meet its obligations under the term of the bond and be unable to repay either the principal or the interest, or more likely both. Now, government bonds issued in local currency are not normally subject to credit risk, as the government can always print the money to repay them. The danger then is, as in the case of Turkey, that principal and the interest are repaid, but in devalued currency. Bonds that are subject to current credit risk are government bonds in foreign currencies, such as Sri Lankan US dollar bonds, municipal bonds, and corporate bonds. This is a beginner's guide to bonds. We're not going to go into credit risk in great depth, because in order to properly assess credit risk, you need to delve into the specifics of each particular bond and each particular issuer. And frankly, that takes a great deal of knowledge and expertise. But you can think of credit risk as being comprised of 5 principles. The credit history. So does the issuer have a good history of repaying its bonds? Does it have the capacity to repay? Can it repay the principal by selling assets? So what is its balance sheet like relative to its debts? And if the issuer does get into difficulties, what are the specific conditions attached to the bond? Where do bond holders stand in relation to other creditors? If you consider the case of a company with £100 in assets and 2 bonds in issue, each of £100, then it's got assets of £100 and debts of £200. Now, if one of those bonds is senior to the other, then bond holders of the senior bonds have full title to the assets, the £100 of assets, and they will be paid out in full. The holders of the junior bonds, who are also owed £100, will have claim on nothing. The senior bondholders will sell the assets and repay themselves in full, leaving nothing for the junior bondholders. Also, is there associated collateral? So in the case of the company we just talked about with assets of £100 and 2 bonds, if the junior bondholders have specific claims over some of the assets, they could get some money back depending on how the bonds have been worded, what their legal titles are. And finally, what is the legal jurisdiction of a bond? If you're holding bonds where there's any sort of international angle, either government bonds issued in foreign currency or bonds issued by a corporate, either in different currencies or in different jurisdictions, you need to know which court will decide on any legal disputes. For example, if you were to buy an Argentinian bond, it is crucial to know whether disputes will be settled in an Argentinian court or in a British court, for example. Your chance of enforcing your rights are much better if the legal jurisdiction is in the UK or the US. Bottom line is that for viewers of this podcast, which is a beginner's guide to bonds, you should be really, really wary of taking credit risk. To understand credit risk properly, you need to have a great deal of experience, and you need to have a great deal of due diligence and be willing to go through the details of each individual bond, and it is worth paying a fund manager to do that. There are many examples of investors who have bought bonds in individual companies being wiped out when that company has gone bankrupt. And this example is from Italy in 2015, when the Italian government allowed some local banks to go bust, and individual Italian investors who had been sold bonds issued by those banks lost everything. Be wary of investing in individual bonds issued by corporates or municipalities. And I will do something on this in the weekly, but I remember back in December 2003 when the big multinational Italian dairy company Parmalat went bust. And this was a fraud that unraveled very quickly, and around 100,000 European small investors, primarily in Italy, lost around 7 billion euros in total. Some investors lost their life savings. And this company was a household name. It looked financially solid. At the time it went bust, there were 29 investment banks issuing buy and sell recommendations on the company. And of those, only one had a sell recommendation. So it was seen as a good, solid company. The reality is that as private investors, we are at the end of the information chain. And really, you should not be investing in individual corporate bonds unless you have a great deal of expertise, which frankly, I don't have. Now, to help you in assessing the risk of individual bond issues, there are credit rating agencies who are meant to do a lot of the work for you. But during the Great Financial Crisis, it was revealed that their services are paid for by the bond issuers, and therefore they have a conflict of interest. And one of the reasons the Great Financial Crisis was so bad was it turned out that the credit rating agencies had given very good credit ratings to a lot of bonds which actually had a high risk of default. So they have their place, but their ratings should be treated with caution. In particular, they tend to downgrade bonds only after bad news. So their value in predicting defaults is open to question. This is the credit rating scale. You see there are 3 bond rating agencies, and they each have slightly different scales. Anything above Baa3, according to Moody's, is considered investment grade. Anything of Ba1 and below is considered junk or high yield. And credit ratings matter. So these are the yields on different Eurozone government bonds, and the x-axis gives you their credit rating, the y gives you their yield. The lower the credit rating, the higher the yield, and the same is true for corporate bonds. So some terms. Investment grade, as we've seen, is any bond with a credit rating of BBB minus or above, and lots of bond funds have a mandate where they can only invest in bonds of investment grade. High yield or junk bonds are bonds with a credit rating below investment grade, i.e. a credit rating of BB plus and below. Covenants are the legally binding obligations that the borrower agrees to as part of the condition of the loan. Covenants can come in many shapes and forms and could say that the company is not allowed to sell assets, it has to keep a certain asset to debt ratio, etc., etc. The seniority is where the bondholders stand in relation to other creditors in the event of a default. You will have seen in the weekly this chart. This shows the credit spread, which is the difference between the the yield on high yield, i.e. junk bonds, and the risk-free rate, which is the yield on US Treasuries of similar maturity. And the thing to take away from this chart is that credit spreads are very highly pro-cyclical. So during the pandemic, they shot up to 11%, collapsed again as the economy recovered, and are now rising once more. Bottom line, be very wary of investing in any individual bonds that have credit risk. It is worth paying for the expertise of a professional fund manager to assess those risks for you. And if you're going to invest in bonds with credit risks, then investing in an ETF or an investment trust which holds a large basket of appropriate bonds is a good way of diversifying away credit risk. And if we go back to the chart of the credit spread, the time to think about buying high yield bonds or junk bonds is the bottom of a recession or when there's been a big sell-off. So let's talk about the credit risk of government bonds. So government bonds denominated in local currency should have low credit risk because the government can always print the money to repay the bonds. The danger then is, of course, that bondholders are repaid in devalued currency. And you will have seen from the earlier chart that governments with lower credit ratings have higher yields, so they have to pay more in interest rates to compensate investors for the higher perceived risks. And credit ratings and indebtedness are also correlated. So the more indebted a government, the higher the yield on its bonds, i.e. the higher the rate the market demands to invest in those bonds. And we've seen over the course of the last month in the UK how highly indebted countries must maintain the confidence of the market in order to keep their bond yields down and to remain solvent. The rise in UK gilt yields would have meant that when the UK came to issue new bonds, it had to do so at a higher interest rate, which means that it would have had a higher interest bill. And so in order to balance its books, it would have had to cut spending to pay higher interest. So the solvency of highly indebted countries is dependent upon maintaining the confidence of the market. And you will have seen how essentially the market has caused a change in the UK government. However, and thank you very much to our Discord member, Wayne J, for pointing this out to me, governments can and do default on their local currency sovereign bonds. So Venezuela did so in 98, Russia did so in 98, and Jamaica did so twice in 2010 and 2013, amongst others. And the reason is inflation also has economic and political costs, and inflation only really works in reducing the value of debts if those debts are long-term. So if long-term bonds, you can inflate away the real value, but short-term bonds, you can't really, because as those expire, then you need to issue new bonds at higher interest rates to reflect the higher inflation. And so inflation is not an effective way of escaping high short-term debts. And a debt restructuring may actually be the more palatable option. And that is what Jamaica, for instance, has chosen twice. And this chart illustrates the earlier point that countries with higher debt to GDP ratios, i.e. more indebtedness, tend to have higher yields. So investors demand a higher yield to compensate them for the higher default risk. Okay, let's quickly talk about UK government bonds, known as gilts. As I've described, UK gilts are exempt from capital gains tax, although they are not exempt from income tax. And UK high-rate taxpayers who wish to invest in gilts in the most tax-efficient manner should be looking to buy low-coupon bonds where most of the return comes in capital appreciation, which is tax-free. Now, gilts are quoted on the London Stock Exchange, but they're mainly traded off exchange between bank trading desks. And there are a lot of UK gilts in issue. So make sure when talking about individual UK government bond, you get the correct ISIN. So this is a page off TradeWeb, which just gives you the details of all the UK gilts in issue. And this is just one of 8 pages covering 237 different bonds. So make sure you get the one you want. And we described earlier how long maturity bonds are very sensitive to changes in interest rates. This is the 2071 gilt. And you'll see that back at the beginning of last year, it was trading above £150 and it fell to a low of £41 after the mini budget. So that was a fall of over 72%. So long dated bonds have had an absolutely terrible year. But there's also the opportunity there in that if inflation comes back under control and interest rates peak and then start falling, and if the price of the 2071 gilt were to go back to anywhere near its prices in 2020 and 2021, then that would involve the price doubling or more from its current £62. Government bonds denominated in foreign currencies do have credit risk because although governments can print their own currency, they can't print foreign currencies. And so we saw that Sri Lanka earlier this year defaulted on its US dollar bonds. You should also be aware that Eurozone bonds have some credit risk in the form of redenomination risk. The risk that the country falls out of the Eurozone and then repays those bonds in devalued local currency. So Greece and Italy, for example, their bonds do have some redenomination risk. However, each individual bond issuance will be different. Redenomination risk will depend on the details of each bond. We can measure redenomination risk by the different prices of bonds which mandate that they're repaid in euros and ones that do not. And these are the prices of some Argentinian US dollar bonds, and you can see that they are trading at cents on the dollar as their chance of being repaid keeps on falling. So quickly, these are some government bond ETFs that you may wish to consider. Vanguard US Treasury Bond ETF, ticker VDTA. The iShares Global Government Bond UCITS ETF, ticker IGLA. And the iShares JP Morgan US Dollar Emerging Market Bond UCITS ETF, JPEA. There are lots of bonds out there. Buying an ETF gives you good diversification. This is the Vanguard US Treasury Bond ETF. As interest rates have risen over the last year, so its share price has fallen. This is the iShares Global Government Bond ETF. It is available in 2 different asset classes. The Blue line is US dollars. The orange line is hedged into sterling. Now, as sterling has fallen this year, so it would have been better to buy the US dollar version. Now, not all brokers will allow you to trade in all lines, so check. This is the JP Morgan Emerging Market Bond UCITS ETF, and for the absence of doubt, I think it's way too early to be considering buying emerging market bonds. And again, the sterling hedged version has underperformed the US dollar version. Okay, corporate bonds. A big difference between corporate equity and corporate bonds is that corporations generally have only one or possibly two classes of equity. The majority of companies only have one class of equity, but they issue lots of different bonds, and the different bonds will have different currencies, different coupons, different maturities, different covenants, different issue sizes. And all of that means they will have lower liquidity. They will be traded less frequently, if at all. So when trading in corporate bonds, you should also be aware of potentially much higher trading costs and large bid-offer spreads. Barclays, for example, has pages and pages of different bonds listed on the London Stock Exchange website. If you're interested, go and take a look. And you'll notice that these bonds, and this is just one page, have different issue sizes, different currencies, different coupon yields, different maturities. So this one is in euros, 50 million euros were issued. This one is in sterling and had only 1 million issued, etc., etc., etc. High yield bonds are highly pro-cyclical. As the economy improves, risk appetite and sentiment improve, corporate finances improve with rising revenues and profits, and that means falling default risks. And as default risks fall, so credit spreads tighten. High yield bonds then perform very well, better than investment grade in an improving economy. In a deteriorating economy, the opposite is true. All that positive feedback loop turns into a negative feedback loop, and high yield bonds perform very badly. To be clear, I think that it is way too early to be considering buying high yield bonds. You want to buy high yield bonds at the bottom of a recession, not as we go into a recession. And this is credit spread chart from the St. Louis Fed going back to 1997. Bottom line, investment grade corporate bonds are low risk, steady return. Junk bonds are high risk, high volatility, but potentially high return if you buy them at the right stage of the cycle. In all cases, buy ETFs rather than individual bonds. In the case of junk bonds, you really need to sell them at the first sign of an economic slowdown. So some corporate bond ETFs you may consider: the iShares Euro Core Corporate Bond ETF. It's a ticker IEAC. The iShares Dollar Corporate Bond ETF, which is huge and has a ticker of LQDE. And the iShares Dollar High Yield Bond ETF, ticker SHYU. And this is the Eurozone Corporate Bond ETF. Again, it has both US dollar and sterling hedged varieties. This is the US Dollar Corporate Bond ETF. And this is the High Yield Bond ETF. So, coming to the end, essential takeaways. Number one, As interest rates rise, so the price of a bond goes down and vice versa. As interest rates fall, so the price of the bond goes up. Coupon payments on bonds are fixed and do not rise with inflation, unlike equities. And following on from those points, bonds perform well in a disinflationary environment and badly in an inflationary one. And one of the reasons that bonds have performed so badly this year is we've moved from very low inflation during the pandemic to very high inflation. So we've gone from inflation of well below 2% to inflation in the UK of approaching 10%, and that has been extremely bad for bonds, long-term bonds in particular. Other key takeaways. The duration gives a measure of bonds' price sensitivity to changes in yield. The higher the duration, the more sensitive the bond to changes in yield. Long maturity, low coupon bonds have high duration. Index-linked gilts have very high duration and may actually provide very poor inflation protection in a period of rising inflation, as we have seen over the past year. UK government bonds, gilts, are exempt from CGT, and so if you're a higher rate taxpayer, you should be looking to buy low coupon gilts and get most of the return in the form of tax-free capital appreciation. Gilt ETFs are not CGT exempt. And finally, avoid taking credit risk on individual bonds. Instead, consider buying an ETF which is professionally managed, so you're paying professional managers to examine all those risks for you, and also you're getting diversification. Okay, that's it. Thank you all for watching through to the end. I hope you now feel informed enough to consider buying government bonds and corporate and emerging market ETFs, and also to watch the rates section in the weekly, which I think is possibly the most important section at the moment. Now, special thank you to all our Discord members for helping me put this together and for proofreading it, and in particular to Wayne J. Okay, that's it. Please can you press like and subscribe to the channel, and it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.